You're about to hear my conversation with Hussein Sunderji, portfolio manager with the Mackenzie Ivy Foreign Equity Fund. Today, we're going to talk about how Hussein and the team have navigated a tricky investment landscape over the past 24 months, how the team is thinking about the current environment in an era of growing trade protectionism, and finally, we'll dig into the details of the team's buy and sell discipline, and even get Hussein to name names. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, Head of Portfolio Construction and Mackenzie Private Wealth. Today, I'm joined by Hussein Sunderji, who is portfolio manager with the Mackenzie Ivy Foreign Equity Fund. Hussein, thank you for joining us on the podcast today.
Thanks a lot, Rajan. Good to be here.
Hussein, why don't we get right into our conversation? For all investors, we are living in very interesting times right now, but the truth is they've been interesting times for more than a couple of years. Maybe you could kick our conversation off with sharing with the audience how you as a portfolio manager have been navigating this environment, say over the last 24 months.
I think first and foremost, as you would know, a key hallmark of the Ivy investment philosophy and our style is to really focus on high quality companies, think long term, and pay very close attention to valuation. So we have stuck to that over the last couple of years. I would say if we go back to 2023, the market was very strong. It was driven largely by the US and technology stocks within the US, specifically, especially towards the back half of the year. Stocks that are focused on the AI thematic. And so for us, it was very important to stay level-headed, not get caught up in certain thematics, but then maintain that focus on quality and also maintain balance in the portfolio. So that's really what we were doing in 2023, and then more of the same in 2024. I think the first half of 2024 really did mirror what was happening in 2023. But something changed then in the back half of 2024. There was some increased volatility starting in the summer and then through the back half of the year. And that did provide us with some additional opportunities. And we actually, as a team, we actually embrace volatility rather than shy away from it, provided that we're positioned reasonably correctly going into it. So we use those periods of volatility as opportunities to perhaps improve the quality makeup within the portfolio, improve the return potential within the portfolio. But in summary, I would say we've really just stuck to our knitting over the last couple of years, stay focused on owning high quality companies with really strong balance sheets, companies that can weather any sort of market environment. And that's what we'll continue to do for our clients.
Excellent. Great place to start. Thanks, Hussein. You've mentioned a couple of terms I'm going to come back to. You talked about quality. You talked about the investment philosophy. But thanks covering the last couple of years. I am curious. We're speaking with the ominous threat of tariffs still on the horizon for Canadian investors. Of course, you're managing a fund with a foreign equity mandate, but you consider all of these factors. Looking forward in the near term, do these considerations and what we're seeing on the macro front, do they really impact how you manage money, and how do you really think about these considerations?
Yes, it's very topical. I would say in our global mandate, we're fairly well positioned. As I said, we focus on owning high quality companies. Generally, these are leaders in their industry. They have a scale advantage. They would have a really strong supply chain, diversified supply chain, and are just generally competitively advantaged compared to their peers. So we think generally the companies in the portfolio are very well positioned. And should there be any tariff impact, we actually think that the companies that we own would not be the only ones impacted. So we think the other companies in their industry would likely also be impacted. And then our companies, being bigger, stronger, and having more financial heft, would perhaps be able to take advantage of those opportunities. Where I do think it would have an impact into how we are looking at things is just in the resulting volatility. So whether or not there's a reason for some of these companies or the share price of some of our companies to come off because of any tariff announcements, we would look at those periods as potential periods of opportunity to either wrap up a weight in a particular stock or look for new opportunities where there may be a valuation disconnect relative to fundamentals.
So you just mentioned how you would think about opportunities, Hussein, and you opened our conversation with a couple of references to the investment philosophy. Maybe this is a good time for us to dig in. Provide us some details. What really is the underpinning investment philosophy for the Ivy team?
Before we dig into the investment philosophy, I think it's good to just provide a reminder of what is it that we're actually trying to do. And what IB is about is trying to really carefully grow our clients' capital over time. And so that leads to our objective. And it's really a two-pronged objective. The first element of that is to deliver superior risk-adjusted returns to our clients over the long term and over market cycles. That's the first part of the objective. And the second part of the objective is to do so with a smoother path of returns for investors. And the reason why that is important is because that is actually what's going to help investors stay invested into the fund. Because as you know, Rajan, history has shown that investors rarely achieve the returns of the underlying funds in which they are invested. That's because there's a tendency, because of human emotion, there's a tendency to buy and sell funds at inopportune times. And so we feel that by providing a smoother path to investors, they do not have to worry. They don't have to worry about getting in and out of the fund or the portfolio. They can remain invested and rest assured that the portfolio management team is going to allocate capital appropriately within the portfolio, taking advantage of opportunities, not getting caught up in periods of market optimism, and just working towards delivering a good long-term risk-adjusted return over time. So those are the overall objectives for Ivy. Now, how do we go about executing that? You talked about the investment philosophy. There's different ways to do this, of course. The way we have decided to do it is by focusing on owning high-quality companies and then making sure we own them at reasonable valuations. And so why do we focus on quality? Why is quality important? We think that it is these types of companies that will be able to weather the storm and succeed in various different types of market environments. These are the companies that will have a sustainable long-term earnings power and be able to grow that earnings power over time. These are companies that hopefully will actually be able to take advantage of market dislocations or weak periods of the economy. So that's really why we focus on owning high quality companies and doing so over a long period of time. And the reason why we focus on owning these companies at reasonable or good valuations is because, as you know, you can have a great company and find a really high quality company. But if you buy it or own it at an egregious valuation, that can turn out to be a lousy investment over time. And we've seen that through history. I mean, going back to the Nifty 50 period, going back to the year 2000 and the tech bubble and the tech wreck. And I would even say the year 2021, there were some examples where there were very good companies, but they were trading at fairly lofty valuations. And so the ensuing few years these companies turned out to be poor investments. So valuation discipline and the focus on high quality companies, I think those are two hallmarks of the IB investment philosophy.
Excellent. So thanks for running through the philosophy. You've made not only reference, provided some detail on quality. It seems pretty clear, Hussein, it's not quality at any price. I'm going to ask a question just to help me fully understand the process. As you look at your investment universe, it seems like you'll identify quality companies. Go into some detail, like what makes a company a quality company?
It's a good question, and I think there's various definitions of quality, and I think most investors will say that they aim to own high quality companies. There's very few investors out there that say that their desire is to own subpar companies. So I think where our definition of quality may vary a little bit, or where it may be a bit unique, is number one, we focus on companies with a good, strong competitive advantage, and number two, we try to own companies that have a very supportive corporate culture. So maybe just digging into competitive advantage first. The reason why we think competitive advantage is important is because this is what gives us confidence in the earnings power of a business and confidence that earnings power will persist well into the future. So there's various different forms of competitive advantage. It can be a scale advantage, it can be a technological advantage, regulatory, so on and so forth. But really, for us to be able to identify that competitive advantage and have confidence that it's going to persist into the future, that's a key element that we look for in terms of identifying a quality company. The other is corporate culture, and this is more difficult to get at, but the reason why we want to find companies with a good supportive corporate culture is because we want to make sure that the management team of that company will do whatever it takes to preserve and enhance that competitive advantage well into the future. And so what are some other things we do to try to assess that? Again, it's very qualitative in nature. We look back at the history of the company and try to assess the management actions. We talk to competitors of that company. We talk to people that have worked at that company. We obviously talk to the management. And again, what we're trying to get a sense of is how has the management and how has the company acted over time? What sort of things have they prioritized? Are they trying to really build a strong and sustainable business for the long term? Or are they trying to prioritize short-term profit maximization and share price gains? And so there are things you can pick up when you go through the history of a company to try to get at that answer.
Excellent. You know, Hussein, I've been known to invest a dollar or two myself over the years, and in my mind, Berkshire Hathaway has always kind of struck me as a high quality company. I bring it up because in late February we received the latest shareholder letter from Mr. Buffett, and I'm just curious, what do you think of that franchise, and does that fit what the team would view as a quality company?
It's interesting you bring up Berkshire Hathaway, Rajan. You've certainly done your prep work. So Berkshire Hathaway is actually a holding in the Ivy Foreign Equity Fund. We've held it for I think just over 4 years. And interestingly enough, if you look at the Ivy investment philosophy, in many ways, it's actually rooted in the investment philosophy of Warren Buffett and the actions of Berkshire Hathaway. So Berkshire Hathaway, we think, certainly does fit with what the Ivy team is trying to do. Now, what parts of that investment philosophy, where is their alignment? I think, first of all, if you look at the things that Warren Buffett has talked about, finding companies with a competitive advantage, thinking long term, owning companies that have a good, honest management team that allocate capital well, that are not capital intensive. These are all things that we also look for in companies, and we're very well aligned with that. So we align very closely with the investment philosophy of Warren Buffett and Berkshire Hathaway. I think on top of that, Berkshire Hathaway has a very good and positive and reinforcing corporate culture. If you look at the way that Buffett and the other members of the management team, the way that they talk, the level of honesty, the level of candor, you don't get that from all companies that you look at. The fact that it's clear that they are trying to build a long-term, thriving, sustainable business, that is something that we are very well aligned with. And I think even if you look at the capital allocation track record of Buffett and Berkshire Hathaway, obviously nobody's perfect. And Warren Buffett, as he has said in this annual report, and he said it in the past, he's made mistakes. But if you look at their long-term capital allocation track record, it's among the best that we've seen. And in fact, we track it on a quarter by quarter basis, and you can clearly see that they are allocating capital more heavily into markets and environments where it is more attractive to do so, and they are pulling back in environments where there are I would say less opportunities. So if you look at the last several quarters, actually, Berkshire Hathaway, as you probably know, has been a net seller of equities and is building up a significant cash pile. And at the same time, their own share repurchases have slowed down. This is actually what we want to see our companies do. It would be great if all of our companies were buying back stock at times that were very opportune for them to do so. And this is what we've seen from Berkshire Hathaway and Warren Buffett. And so for the last several quarters, as we've talked about, markets have been very strong for the last 2 years. They've been net sellers of equities and have really ramped down the level of share buybacks. But at the same time, they're now sitting here with a fortress balance sheet. So this all gives us confidence. Again, there's a high degree of alignment between what Ivy is trying to do and what Berkshire Hathaway is trying to do for its investors. They've built up a fortress balance sheet, and this gives us confidence that they will be able to weather any sort of market environment, and they have the ammunition to act in an opportunistic fashion. And so we're quite happy to hold Berkshire Hathaway.
That's so interesting. I want to connect the dots in our conversation, Hussein. That was really interesting. You talked about Berkshire Hathaway being a net seller of equities. We've already talked about the IV investment philosophy. You've given a great overview of how you think about quality companies and valuations. So, how about for you? What would lead you to be reducing a position in a name or to be selling, eliminating a position, however you want to think about it? It's really a question about, you've talked about buy discipline. Talk to us about how that process plays out with regards to sell discipline.
Sell discipline is very important. It's a great question, Rajan, and it's a key part of our process. There's a number of reasons why we would sell or trim a stock. I guess the first reason would be on valuation, and this is a good reason to have to sell or trim a stock. And usually, when this happens, it's because a stock has performed quite well, better than what we would have expected, or better than what the underlying fundamentals would suggest. And so, because of our valuation discipline, as I said, history has shown that great companies, if owned at a at an egregious valuation, can turn out to be lousy investments. So we do have that valuation discipline. And so when we see a stock and the share price drifting away from fundamentals to the point where the long-term potential return of holding that stock is now diminishing, we will reduce the weight of that stock in the portfolio. And if it continues to happen, we have to stick with our discipline, and we will have to exit that stock. And there are a few examples of this even over the last few months, where we've exited companies that we really like, that we think are very high quality, but the valuations just got to a point where we could no longer justify hanging on to these companies. So that's one reason why we would sell a stock. I think the other reason is more around, did we get something wrong? Did we get the investment thesis wrong, or did the investment thesis not play out? And this also happens. And this is why it's very important for us to continuously revisit our investment thesis on every stock that we own. And we have to be intellectually honest and also intellectually curious. It's a key part of the way we operate. And if we see that things are not working out as we had expected, let's say the management is not behaving in a way that we would expect, or is not allocating capital in a way that we think is prudent. Or let's say the environment is unfolding in a way that we did not expect. Perhaps the industry is not as attractive as we thought, or the company's competitive advantage is not as strong as we thought. We have to keep revisiting that. And as part of our discipline, we have to be open to reversing course on a particular company when it becomes clear that the investment thesis is broken. So that is another reason why we would sell a stock. And then I think the final reason is because there's just better opportunities elsewhere, either within the portfolio or outside of the portfolio. And so we're constantly evaluating those trade-offs. The stocks that we own compared to the stocks that are on our short list, or the stocks that we own at higher weights compared to the stocks that we own at lower weights. Are there opportunities for trade-offs within that? So I think those are the reasons why we would sell or trim a stock.
Okay. I really love your focus on discipline when you were speaking about how you approach potential sales or reducing positions in the portfolio. So I want to stay with this idea of discipline because, again, underpinning our conversation, you talked a lot about philosophy, you talked about a lot about the focus on quality companies. So how do you manage that when, if I remember correctly, the benchmark for the IV Foreign Equity Fund is the MSCI World? I think more than 70% of that is the United States. So when you're managing relative to the benchmark, does the fund look a lot like the benchmark?
Yeah, actually, the fund looks very different than the benchmarks. I would say currently our US exposure, we are underweight the US compared to the MSCI World. I think our US exposure is in and around 60%. But what I would say is we don't build the portfolio on a top-down basis. So we don't build the portfolio to look like the benchmark. We're building the portfolio fully from a bottom up perspective, trying to find, as you said, the highest quality companies we can at a reasonable valuation. And then we put it together and we're left with this portfolio of companies. Now, while we don't manage to the benchmark, we are benchmark aware. And I think we use the benchmark to evaluate perhaps where our risks may lie and just to be fully aware of that. I think what is important for investors to understand is for the IV foreign equity fund and all of the IV funds actually, because we're different from the benchmark, because we have this valuation discipline, because we focus on owning high quality companies, there are going to be years where the performance profile looks different than the underlying benchmark. And we see that throughout the history of IV. If we go back to 2021, for example, it was a very strong year for markets, borderline euphoric, actually. And here we are with our valuation discipline and not wanting to chase themes or chase companies. And so we did underperform. But our clients understand that. And they would actually expect us to underperform in those types of market environments. Fast forward to 2022, we actually got hit with a bear market. And the prudence and the defensiveness that was built within the portfolio actually paid off in 2022. And the fund outperformed in relative terms. It outperformed the MSCI World. It performed, much better than the benchmark in the bear market. 2023, again, as we've talked about, very strong year for markets, driven in large part by technology in the US. The fund's absolute return was actually quite good, but we did underperform the benchmark. Again, probably fully in line with what our clients would expect. And 2024, again, the markets were very strong and the fund delivered a good absolute return, but underperformed the benchmark from a relative perspective. So actually, 2024 was also very much in line with our expectations. And so I think the other thing that we try to do is try to make sure we educate our clients and investors on what to expect in terms of performance. And the performance profile has actually been quite consistent over time. Generally, what tends to happen is because of the investment philosophy and the way we manage the portfolio, the fund's performance tends to lag the benchmark in periods where there's a high degree of market optimism. But where we do try to outperform is during those periods of market turbulence or market stress. So through history, when you've put those together, the fund has tended to outperform through a long period of time and through market cycles. And so this is what we try to educate our clients about as well.
Okay. Excellent. We're getting towards the end of our conversation, but I still have a couple questions left for you, Hussein. My next question, when you think about the philosophy, focus on quality companies, does that apply to all sectors? Is the team, you as a portfolio manager, do you look at names in the resource space, financial sector?
Maybe I can speak about the global side, and then we do have Canadian mandates within the Ivy family. On the global side, we we will go anywhere. We will look for wherever there's high quality companies to be found. We will go there. Now, where that does normally take us is into sectors like consumer, increasingly technology, industrials, healthcare. Because again, if you go back to our objective and our philosophy, this is really where we find companies that have a clear and sustainable competitive advantage, companies where we can actually reasonably predict what the earnings power will be well into the future. We tend to find those less in areas such as resources. Banks are a little bit trickier for us because banks historically have not necessarily been good preservers of capital during periods of market turbulence. And some banks can be more difficult to understand. We have owned banks in IV foreign equity in the past, very, very selectively, but we have owned them in the past. And we try to, when we do own banks, what you can be rest assured of is that we will own the highest quality banks out there. We have owned an energy stock or two in the history of IV foreign equity. When we have done that, it has been at a very opportune time from a valuation perspective. And again, we've flocked to owning what we think are the highest quality energy stocks out there. But it's not very common. The other thing that we focus on, as I said earlier, is we focus on owning companies with very strong balance sheets. And so in some sectors, you don't really see that as much. For example, in utilities or in real estate, those companies, while their earnings stream can be reasonably steady, the balance sheets are not very strong, and so they take on more leverage because of that, because of the fact that they have what many view to be a stable earnings stream. So our philosophy and our style leads to us gravitating towards certain sectors, but we will look at any sector wherever we can find good, high quality companies. That's on the global side. On the Canadian side, I think it is a little bit more nuanced. And so there's some more flexibility that's required. And a big reason for that is because the underlying market structure is quite different. There's a significant concentration in financials, specifically banks in Canada. There's a higher concentration in resources, for example, in energy. So but even in Canada, where there is more flexibility to invest in those sectors, our team is seeking out the highest quality companies they can find in those sectors.
Excellent. Thank you, Hussein. We've had a wide-ranging conversation, so I'd like to leave you with the opportunity to share a final thought. It's a tricky time for investors. What do you think is the most important thing investors need to be thinking about as they're investing their capital? I think they'd appreciate the perspective of a portfolio manager who's navigating these markets each and every day. What would kind of be your final thought, even if it's something that we didn't cover in our conversation that you think is important?
Yes, absolutely. I think first and foremost would be to stay the course. Already so far this year, there is more volatility than perhaps if we go back to 2017 and Donald Trump's first presidential reign. There was very low volatility in the market. We've already seen more volatility, and so it can be unnerving for investors. So what I would say is stay the course. Do your best not to get caught up in various themes because those can be fleeting. And in that regard, I do think that IV foreign equity, I know it may sound cliche, but I do think it is an all-weather type of strategy. It's a strategy that you can buy at any point in the market cycle and then own it, but you really do have to have an eye on the long term. And again, you can be rest assured that the portfolio management team is going to try to deliver good risk-adjusted returns, but then also doing so with a smoother path to help everyone stay invested. So staying the course, focusing on quality, and thinking long term. I think those are things that people should be focused on.
Great advice. Hussein, thank you very much. It was great to have you on the podcast and look forward to having you back sometime soon.
Thank you. Look forward to it.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.